Disclaimer. This is an educational case study in quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and it's subject to fair use for commentary and criticism. All right, let's dive right into this. Welcome to today's explainer. Today, we're putting on our equity research analyst hats and conducting a full financial autopsy of Steel Dynamics, ticker symbol STLD. Look, we aren't here for the hype. We are here for a totally objective, data-driven, investigative teardown of their Q1 26 data. We're going to run this stock through the ultimate valuation gauntlet, stress testing it against models from legendary investors to finally separate the signal from the noise.
So, let's kick off the gauntlet by firing through the foundational cash flow and balance sheet metrics. Remember, we treat every single number as hard evidence. Looking at Group A, our discounted cash flow models, like standard DCF and unlevered free cash flow, imply an intrinsic value range of roughly $160 to $180 per share, and that's assuming a base case weighted average cost of capital. We're looking at a trailing 12-month free cash flow of $1.78 billion and operating cash flow at $1.57 billion. When we flip over to Group D, the asset-based metrics, the book value sits at just $65.59. Honestly, if we looked at liquidation value in a true fire sale scenario, it's closer to $45. But structurally, their balance sheet is an absolute fortress, boasting a total debt-to-equity ratio of just 0.45.
Now let's move over to the income and comparable side of the gauntlet. Applying Group B's dividend discount and Gordon growth models, the implied value drops drastically. We're talking around $90 per share, mostly because of that really modest 0.8% dividend yield. But check out Group C, the sector comparables. The stock is currently trading at $255.77. This gives us a trailing PE of 23.2 against a TTM EPS of $11.07. When we run a comparable company analysis against its metal sector peers, the multiple suggests a value closer to $240 per share. And finally, factoring in Group E, real options valuation for their new Sinton and aluminum expansions might add an optimistic $15 to $20 per share. So what does this all mean? The models are pulling us in entirely different directions. Why is that? Well, this stark reality brilliantly illustrates exactly why the models are so fractured. Look at the cyclical nature of their margins. We are witnessing classic cyclical margin compression. At the absolute peak of the steel cycle back in 2022, Steel Dynamics was literally printing money with a 24.91% operating margin. In 2023, that slid down to 18.21%. And now, over the trailing 12 months, it has plummeted to 10.84%. Their profitability has more than halved from the peak. This is just the sheer gravity of the commodities market pulling them right back down to earth.
However, to be completely intellectually honest here, we have to demystify their cash generation. They aren't just your grandfather's traditional legacy steelmaker. They utilize a highly differentiated circular business model, relying heavily on metals recycling and electric arc furnaces. This model acts as a massive buffer against that margin compression we just talked about, allowing them to maintain a really resilient 5-year average adjusted free cash flow of $3.2 billion. It's a hyper-efficient system that essentially keeps the floor from completely falling out during market downturns.
The media blackout, 7 + 7 hidden flags. So the foundation is mixed. Now it's time to dig into the footnotes and ignore the flashy headlines to find the buried truths.
Let's start with the 7 overlooked green flags. Why does the mainstream media completely ignore these? Well, we start with a strong 3-year after-tax ROIC of 13%. Consistent capital allocation is frankly just too complex for a quick soundbite. Furthermore, their low debt-to-equity of 0.45 shows a level of debt prudence that simply doesn't generate clicks. We also uncovered stealthy treasury stock buybacks reaching a staggering $8.08 billion and a slow and steady Q3 cash dividend increase to 53 cents because, let's face it, slow and steady dividend growth is considered boring. Rounding out the green flags, that resilient 5-year average adjusted free cash flow of $3.2 billion gets entirely drowned out by quarterly noise, their circular supply chain model isn't as flashy as top-line beats, and Q1 2026 record steel shipments of 3.6 million tons are often completely overshadowed by broader macro pricing fears.
But pivot to the 7 deep red flags, and the plot thickets. Buried way down in the segment reporting footnotes, their aluminum segment posted an operating loss of $64.5 million in Q1. Meanwhile, momentum traders are completely ignoring historical deep value metrics, pushing the PE to an elevated 23.2. Those top-line revenue beats, they're masking a severe operating margin drop to 10.84%, alongside working capital drains like inventories rising from $3.73 billion to $3.9 billion, which is rarely headline news. Trailing cash flow is down sharply to $1.78 billion from 2022 peaks, often hidden by adjusted EPS figures. Even SG&A line items get skipped by algorithmic newsbots, masking a Q1 profit-sharing expense that almost doubled year-over-year to $42.1 million. Finally, contrarian analyst sentiment is usually ignored during a bull run, but right now, 5 analysts are rating the stock as hold or sell against 9 buys.
So the absolutely crucial point we need to make is this contrast right here. You have their core strength, a highly efficient steelmaking process, generating a 13% return on invested capital, going head-to-head with their biggest current weakness. And that's the expansion risk into the flat-rolled aluminum market, which is currently bleeding $64.5 million a quarter as they commission the new facilities. It's a classic textbook battle between legacy cash generation and the extremely costly pursuit of future growth.
Legendary Investors Reality Check. With all this conflicting data, it's time to check if the investing greats would actually buy STLD at today's price.
First up, the father of value investing himself, Ben Graham. If we calculate the Graham number by taking the square root of 22.5, multiplied by the EPS of 11.07 and the book value per share of 65.59, the result is exactly $127.81. Plus, Graham strictly demands a PE under 15, and STLD is sitting way up there at 23.2. He also looks at net current asset value, which the current price vastly overshoots. The verdict? At $255, the current price completely shatters Graham's deep value test. No way he buys this.
Next, we check in with the growth at a reasonable price legend, Peter Lynch. Lynch's fair value methodology equates a stock's PE ratio to its growth rate plus its dividend yield. So, we take the revenue growth rate of 19.77% and add the 0.8% dividend yield to get 20.57. Because the current PE of 23.2 is greater than the Lynch fair value line of 20.57, the stock fails the Lynch test too. It's simply trading at a premium to its growth rate right now.
And finally, Warren Buffett. Buffett looks for businesses with a durable competitive advantage, meticulously analyzing owners' earnings. So, does it have a fortress balance sheet? Yes. The debt-to-equity of 0.45 easily passes his threshold of being under 0.5. Does it have a moat? Yes, a narrow one based on cost advantage. But does it consistently hit his rigorous 15% return on invested capital target? At 13%, it just barely misses the mark. It might be a great company by Buffett's standards, but perhaps not at a great price today.
Moat and synthesis, the final verdict. Let's pull together all 21 data points and legendary tests for our final synthesis.
First up, the valuation. Based on the average of all 21 models we applied in our ultimate valuation gauntlet, Steel Dynamics definitely leans toward being fairly valued to slightly overvalued at current levels. While the cash flow models and comparative multiples provide some justification for the current price, the severe cyclical margin compression combined with failing across the Graham, Lynch, and Buffett stress tests strongly suggest the upside is currently heavily priced in.
Next, the economic moat. According to Morningstar's criteria, Steel Dynamics absolutely possesses a distinct cost advantage. This is driven by their highly efficient, circular electric arc furnace model. However, we project this moat trajectory to be stable to slightly shrinking over the next 3 years. The heavy capital expenditures and the current operating losses stemming from their new aluminum division are actively diluting their historically pristine returns on capital.
Ultimately, the nuance here is key. Steel Dynamics is an exceptionally well-run company navigating the really harsh realities of cyclical commodity pricing, all while simultaneously trying to fund a massive aggressive expansion into aluminum. The models are pointing one way, but hidden flags suggest a storm. Which side are you on? Do your own homework.